You're about to listen to the Yet Another Value podcast with your host, me, Andrew Walker. Today's podcast is Chris Waller from Hidden Gems Investing is on. We're going to talk about Judges Scientific. Chris is one of my favorite guests to have on the podcast. This is his third appearance. I think when you listen to the podcast, you're going to understand why. Chris does fantastic amounts of really in-depth research, really understands the names he pitches well. And he has, he does a blend of value investing and special situation investing. This is much more value than special set, but I love anyone who marries those two skill sets. So I think you're really going to enjoy this one. We'll get there in 1 second, but first, word from our sponsor. This podcast is sponsored by Trada. Look, I already know you're going to like Trada. Why? Because you're interested in this podcast. You're listening to this podcast. And Trada is just like this podcast, though, unfortunately, largely without the handsome host. Trada is anonymized transcripts of buy-siders discussing their stocks that they're following and kind of what they really think will drive the stock, what they really think the upsides are, what they really think the risks are. In fact, a huge way that I prepped for my Sell Break podcast is there was an incredible discussion on the Trada platform where they were talking about, hey, here's the risk. Here's what I think the event path will play out. Here's what I've heard from experts who I've interviewed when I've talked to them about what they really think about the podcast. So look, I think if you join Trada, you're going to get huge value, but even better, you can join as a lurker and you can just go and read all the transcripts. But if you want to join and actually start contributing to the platform too, Trada will take it one step further and it'll be an anonymized interview. They'll publish it and they'll pay you hundreds of dollars to go on the platform and do anonymized interviews and talk about the stocks you follow with other smart people who follow the stocks and long, short, all that type of stuff. Nothing investing advice anywhere, but it's a really useful platform. And again, if you're listening to this podcast, I already know you're going to love the podcast. Go to trytrada.com or see the link in the show notes today to check it out. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. With me today, I'm happy to have on, I think it's the third time, my friend, the founder of Hidden Gems Investing, Chris Waller. Chris, how's it going?
Good. Thank you for having me on again.
Hey, thanks so much for coming on. Before we get started, I'm going to give 2 disclaimers. First disclaimer, nothing on this podcast is investing advice. Full disclaimer at the end. Second, I mean, Chris is a friend, but I'll tell you, Chris runs one of my favorite Substacks on, I guess, the planet, is fair to say. It's, in my mind, it's the perfect type of Substack. I mean, I get 2 emails a month from it, but they're well thought out, super deep in quality research. You know, I get everything from the compoundery stuff we're going to talk about today to every now and then cash sell special situations, which I love as well. So I love it. It's one of the few emails I read pretty much everything that he writes. So if that's not a good pitch, I don't know what is, Chris. But let's talk about something you wrote. You wrote it up. I instantly said, hey, you got to come on and talk about it. The company is Judges Scientific. It trades in London. Disclaimer, international stock, maybe a little extra risk. But I'd love to dive into it. What is Judges Scientific and why are they so interesting?
Yeah, no, thanks for that, and thanks for mentioning Hidden Gems Investing.
Well, I mean, my check's in the mail, I'm sure. So
yeah, and of course I should say I own Judges Scientific through my fund as well. So just full disclosure there. Yeah, Judges is a UK listed 400 million pound market cap serial acquirer. It buys scientific instrument businesses. So these are usually companies that are very niche. They're almost always the leader. In some cases, they're even a monopoly in that specific niche. So very low competition, very high pricing power. These are small private businesses with a liquidity event like a founder exit. And Judges has a really strong track record here. So they, over 20 years, they've delivered about 20% per annum return on incremental capital. The stock has returned similar amount, about 25% per annum. And these are good businesses. So they're not companies that need turning around. I think return on tangible capital is about 40%, 40%. Organic EBIT growth about 9%. And like I say, they're small private businesses, usually 5 to 10 million pound deals. They're nearly all in the UK, but they sell roughly 1/3 in the US, 1/3 in Europe, and 1/3 rest of the world. Judges has been incredibly disciplined in its acquisitions. So they have a founder CEO who owns stock worth about 200 times his base salary. They buy companies on average for about 5 times EBIT, 6 times if you kind of weight it, if you do a weighted average. And the most important thing is they're just very, very disciplined on that price paid. So there have been multiple 2-year periods where they didn't make a single acquisition. They've done 25 in total over 20 years. And I imagine that would have been extremely difficult for a serial acquirer. So very disciplined on price, very high integrity. And the reason that they are able to get these businesses at such a low price is because they're very hands-off post-acquisition. So they don't extract synergies, they don't merge the companies or the brands. They're not like private equity. They're not going to load them with debt. And basically, they're going to leave them untouched. And I spoke to quite a lot of founders who sold their businesses to judges in this process. And all of them told me that's the reason they sold to judges. So
can I pause
that's
you
the
right
reason.
there?
Yeah.
I've got lots of questions. I'm going to let you continue. I just want to emphasize one more thing. When I say Chris does work, I've been like, maybe not so sneakily, but I've been trying to do expert calls with everyone who comes on the podcast, right? Like I'll do an expert call through Tegas Alpha Sense, obviously have a relationship with them. And I had them drum up a list of 12 experts and I sent it over to you. And your response was, oh, I've already talked to all of them. So if you've already talked to all the experts in the company, like doesn't mean the stock's going to work or not, but it just spoke to the diligence. And I wanted to mention that when you said I spoke to farmers, because I know you did. We had like
Yeah.
12 and none of them were new to you.
Yeah, well, yes, and unfortunately, it doesn't guarantee you get the investment decision right, even if you do all the work. But I think it gives you a better chance. And a lot of these companies I'm looking at, they're small, and so yeah, that you can definitely learn more about an industry.
Let's dive into a bunch of different things and just real quickly to level set for people. Again, judges, they're doing lots of small acquisitions, but can you just one more time like give an example of the type of company that they would acquire?
Yeah, so usually a private business with a founder who wants to retire either immediately or soon afterwards. These types of scientific instruments are things like vacuum chambers, ultra low temperature cooling, analysis of different soils and rocks. This type of equipment is generally thousands of pounds. In a couple cases, it can even go up to £1 million for a whole system. So very high tech equipment.
Yep. And I think it will come into play in a second. This is the type of equipment you're going to find, not all of the stuff, but a lot of it is going to be in university laboratories, right? Like
That's
they're
right.
running
Yes.
hard science. It's not as simple as just the microscope that they say, but I think it was in one of your posts,
Yes.
or maybe it was in their investor deck. It was like a 15-fold microscope with all sorts of different things. So really fancy
Yes.
stuff. Let me ask the question I like to start every call with. Okay, great overview. Loved it. But the market is a competitive place. What do you think you're seeing that the market is missing that makes judges a alpha opportunity?
Yeah, and I think one thing I should add as well, it does trade on 21 times free cash flow, which maybe seems like a kind of optically, premium or doesn't scream cheap automatically. I think that if they can redeploy capital at these 20% returns for long periods of time, that means their earnings are going to grow at 20% if they can redeploy 100% of earnings. And so you can still do you can grow earnings at 20%. And if it holds its multiple, you can still generate that return as an investor. And there's a lot of serial acquirers with this type of success that trade at a high multiple even. I think in terms of what investors are missing, I mean, aside from the fact that it is still small, 400 million market cap, despite this track record, they've also had quite a lot of short-term headwinds. So the stock is actually down by almost half since its peak 18 months ago. Really the first time they've had a drawdown of this scale. And the reason is they had an issue in one of their subsidiaries, the biggest acquisition they made called Geotech, which had a quite significant decline in earnings. So we might touch on that. They also had a period where, because they sell some products into China and there's been some macro headwinds there, that impacted them. And then most recently, they've had this issue around US college spending, which has fallen quite significantly. And so those three kind of headwinds are, I think, what's basically, causing investor concern. And then there's a longer term issue, which is how long can they keep doing this for? The founder's 76. If so, that's probably the longer term issue.
Look, you hit all the questions that I'm going to ask, but I'll try to earn my bones as a good podcast host and add some meat onto those bones. So let's start with the acquisition, right? So they call it their buy and build model, and they say like, look, They gave lots of reasons, and we can dive into them why they can buy at 5. But I do still want to push on that a little bit, right? Like they say, hey, we're going to go buy these businesses at 5 times EBIT. And in the way they talk about it, they say, oh, and by the way, we're going to lever it up 3 or 4 times EBIT, right? So we're only putting in 1 or 2 times our cash. We get a 20% return, but it's even better than that because we put the cash flow in. And look, I had the same pushback on TerraVest when we talked about this. And I have the same pushback when we talk, Constellation Software is the one everyone's going to think up on these roll-up things. And there's plenty of others. But my pushback is, hey, look, I get if I was selling to judges versus a middle market private equity shop that was going to fire 70% of the employees, maybe I'd take a little discount, but 5 times EBIT, 20% return that you can also lever up. Why are people giving them such a good deal? It seems like such a good deal here. And I always question, like, why is the seller going to give someone a good deal?
Yeah, there's a few competitors that judges face and a few sort of coming up. So, I mean, aside from private equity, you've got some companies like Oxford Instruments, Thermo Fisher that are operating in this type of scientific instrument business. And they make acquisitions like this all the time, but they're going to consolidate your business. And the reason, in their opinion, for doing that is they think they can extract all these synergies. And so that is why they approach it that way. In terms of just very hands-off companies, there is one other publicly traded company called SDI, which basically has an exact same approach of hands-off, making these acquisitions. Sometimes they bid on the same deals as judges. But I think that's a good example of why it's really difficult to do, because they actually changed their CEO fairly recently. They've got a new CEO who is very much emphasizing synergies, and he's pointing to sort of obvious things like, hey, why don't we have 5 companies go to market as one, or exhibit together? And these things seem really obvious. And so there's just a lot of conventional wisdom that that's the way to extract value. The problem with that is you then put off these founders, and there are some founders who are willing to sell for a cheaper price because they really care about the company not changing, and so it's difficult to maintain that discipline.
If I could just like pick at this point a little bit, so everyone's aware of search funds, right? At this point where you basically get a Harvard grad and they say, hey, instead of going to private equity or banking, I'm going to raise $3 million and I'm going to go buy the local HVAC or plumbing company and I'm going to apply kind of Harvard MBA skills to it. And maybe we'll go buy, the company, the city over eventually. But they basically say, hey, I'm going to go shake hands with the local plumber and he's going to sell to me because I'm going to operate it and I'm going to standardize it, but I'm not a private equity firm that's going to fire everyone. And because of that, I'll get a deal. And that historically has worked quite well, I believe. But I've been worried about that because even if that works well, right, there's a lot of Harvard MBAs out there. And, you hear of all these plumbers who, hey, every month I'm getting 100 emails from search funders. And I do wonder with judges, like you mentioned SDI, which seems to be changing the model. But judges had this quote on one of their calls where they said, hey, over the past 20 years, the multiple we pay for businesses that we buy has not changed. I was thinking about this, like, that's really interesting, but it hasn't changed at all with like more financing and the ability to copy this model and like funders and small Ps. I was just really surprised that even if they've got like kind of a little moat versus private equity, it just doesn't get competed away by other people rolling out the same kind of like aw shucks Berkshire Hathaway style playbook. So what do you think about that for acquisition?
I think it will take a long time for someone to replicate their reputation, because they've been doing the same thing for 20 years. And let's say tomorrow you and I, we took the exact same approach and we could really do that. What founder is really going to sell to us over judges when we haven't made an acquisition, or we've only made 1 or 2, when judges have a whole list of 25 companies who you can speak to? And, the founders will very openly tell you that, these guys are trustworthy. And a number of the founders mentioned to me that when they were going through these negotiations, they had reference checks not from people judges provided, but from people they knew and who were able to vouch for judges and say, yes, you really can trust these people. They're not just saying all of this in the acquisition phase and then they're going to change. So I think it will take quite a while for someone else to build that same reputation. And these acquisitions are small. I mean, 5 to 10 million pounds, and so there isn't as competitive a bidding process as there would be at a bigger scale.
The other thing I thought was interesting, you say not competitive. I thought it was interesting. I think it was on the Q4 call as well. They said,
Yeah.
hey, a lot of our acquisitions, we were actually the runner-up bidder, and
Mhm.
we don't retrade.
Yeah.
We bring financing to every deal. We can sign on the dotted line. You can trust us. And they said, hey, a lot of times we're the backup bidder, but every now and then the winning bidder falls through, and people just come to our backup bid. And I thought that was really
Yes.
interesting. And if you're winning something, you say, hey, we were the runner-up bid. There was a higher bid out there, but for XYZ reason, we got it. That's always really interesting to me.
And I think about a third of their acquisitions, there's actually no competition, something like that, of that order of magnitude.
Let me ask another question. Sustainability of the model. So they do 1.3 acquisitions per year is their history. Let's just round it down to one to make the numbers easier, right?
Yeah.
When you're doing one acquisition a year and you're $100 million company and you're buying a $5 million company that, maybe after you kind of like standardize some procedures and put a 10x multiple, it was worth 20. Well, that's a lot of value creation, right? Particularly if you use some debt, that's a lot of equity value creation. But this is a $400 million, $500 million company now. So they either need to do bigger acquisitions. So instead of doing a 4 million
Mhm.
acquisition, they need to do a 16 or 20 million acquisition to make that same like accretion per overall work, or they need to accelerate the acquisition. So, I when I look at this, my first worry is, hey, Chris is right. He found something that historically has delivered great returns. The acquisitions were great. But these are really small acquisitions, and there just aren't enough of them to move the needle anymore. So, do you think they can
Yeah.
continue to kind of find enough deals to move the needle and create this value creation that, as you said, at 21 times free cash flow, you are baking in acquisition kind of related gains?
Yeah. Yeah, I think that I mean that's definitely the challenge. And I think they've done a few things that are going to help them make more deals. I mean, ideally we want them to make more of these small deals, not move up. They've done a little bit of moving up, one or two bigger deals, but you get the lowest prices at the um, with the smaller companies. So they've significantly expanded the management team. If you go back 2 or 3 years ago, there was only really three of them. So there was the founder CEO, the CFO, and the COO, and that was basically it at the head office. They've now got three other people who have come in over the last 3 years, and so their core team is pretty much doubled. That's going to give them a lot more management bandwidth to be able to do a larger number of deals. Um, they're still very early on right now, but starting to create some platforms. So some of their acquired businesses have started making acquisitions of their own. That's very, very early on at this stage. So too early to really say it is a platform, but that's something else that they're working on. Um, the other thing is, they've been quite focused on the UK. But they have made one or two acquisitions outside the UK, and they haven't gotten the prices they'd want, which is why they haven't made more than those one or two. But that's something that at some point they could do more of. Um, and even the industries that they look at, that scientific instruments is a great sector to be in, but there are a lot of sort of adjacent industries, and depending on how you want to categorize the industries they look at, there are actually thousands of companies. So I think I mean, they're working on all of these areas. But yes, that's going to be the challenge.
So you mentioned, look, you'd love to do as many of the smaller deals as you can. You get the lowest price. They tend to be the most strategic. Like even if you're not rolling them up in terms of firing people and synergies, you can probably toss them on your CRM, your
Mhm.
accounting, all that sort of stuff. And I think they've got a slide in their deck that says, hey, here's some of the standardized things we do. So you can get, you know, look, if accounting software costs $50,000 per year and you buy a $4 million business, that's a nice synergy. You buy a $40 million business and you put it on yours, so you save $50,000. It's meaningless. So you can sell that. But I want to talk about Geotech real quick, and not specifically
Mhm.
Geotech, but just Geotech was by far their largest acquisition. I think they
Yeah.
spent, including the earnout, which probably doesn't get hit at this point, but if you include the earnout, it was over 100 million pounds was the acquisition. I think 3 times larger than their previous largest deal, and probably
80, I think. Yeah, but
yeah,
yes, by far the biggest. Yeah.
and probably 8 to 10 times larger, maybe even more than their
Mhm.
average deal. And
Yes.
Geotech has been an issue. We can talk about the issues at
Mhm.
Geotech, but I just want to ask that high level. When I look and I see, hey, the company took this serial compounder, serial acquirer takes the biggest swing by far they've ever done, and it's the worst acquisition they've ever done. I look at it and say, ooh, might have trouble scaling that model, guys. So, what do you think? Just the overall Geotech learnings.
Yeah, and I would also wrap in as well. There've been a couple acquisitions that haven't been successful. That's Scientifica and Armfield. Those are, about £8 million acquisitions each. So historically on the larger end, although not like Geotech. And so sometimes investors, yeah, they're looking at this and saying, well, hey, when you scaled up, your acquisitions weren't so good. So maybe this, doesn't work as you scale. I would say probably a few things, which is there have been some acquisitions of this scale that have worked very well. So GDS Instruments was one. They just did relatively recently bought a company called Tia Coatings, which looks like it's a very good fit. And I think I was looking through the data. 7 of their previous acquisitions have now grown to a scale where they're of a similar level or bigger than the Scientifica and Armfield. So there's nothing kind of unique about the £8 million number where they can't go above that. That's still a very, very small company, £8 million. With Geotech specifically, I think they had an issue. Well, maybe just to give you a bit of background on Geotech. Um, it's about 20% of the company's free cash flow right now. So meaningful. They analyze soils and rocks. So for oil and gas, drilling, mining, where they need to know where to drill. This type of analysis is very important. And Geotech is really the only provider in something called multi-sensor non-destructive analysis, which means that basically they can take a sample, they can analyze it in lots of different ways in a way that doesn't destroy the sample. You can use it again. So it's a company that fits in very well with the style of business Judges likes to acquire. Now the thing that went wrong last year. So this company was acquired just over 2 years ago. The thing that went wrong last year is that about a third of Geotech's business is providing equipment for an expedition. So this is literally a vessel that's going to go out at sea and help basically map the ocean floor to figure out where to drill and so on. Um, Typically, they do one expedition per year. There was no expedition last year, and so that loss of revenue drops through entirely to profitability. And so Judges as a company actually saw negative revenue growth and a decline in profitability last year. That's actually reversed. So the first half of this year, there was the expedition as normal. That's reversed. I actually don't see any reason to believe that this acquisition won't work long term. So I think that it's still very early. We only really have 2 years of data. It looks like the headwinds they had reversed. So yeah, I know a lot of investors look at this and just have concluded this is a kind of failed acquisition, but I think it's far too early really to say that.
I think the company probably agrees with you. Let me just say on the one expedition, I was kind of surprised when you've done literally 1,000 times more work on this than me, but I was kind of surprised when I was reading there to say, hey, this much of the revenue and earning streams comes from one expedition per year.
Yeah.
And this year we didn't have one. And it's like the year after
Yeah.
they did the acquisition, right? Could you just talk about, so the expedition, it sounds like it's for oil and gas mapping the ocean map, but could you just give a little bit more detail to the extent you know about, what is going on with this expedition? When you say there's only one per year, I'm like, oh, is Exxon the only one who uses it and Chevron and everyone else is using someone else? Or like, well, what's just kind of going on with this expedition? Can you give more color on that?
Yeah, so I believe it's a Japanese vessel that they provide all this equipment to, and historically it's been one per year. This one actually got delayed, so it happened early in 2025 instead of in 2024. So it wasn't cancelled. And historically they've done one per year. There's, I believe, only 4 vessels like this in the world that can actually do these types of expeditions, and I think they're sort of quite geographically spread out. So. Uh, that's a third of their business. It's not the other 2/3 where they're almost a monopoly, but it's still one where there's obviously very limited competition. It's very specialized. So I don't see any reason to kind of extrapolate that there's something wrong with this business. I would also say as well, although this Geotech is 20% of Judge's free cash flow today, being, and by far the biggest acquisition, if you look at the rates they will probably compound at, by making more acquisitions going forwards and growing EBIT at sort of mid-high single digits, it's probably only 15% of free cash flow in 3 years and 10% in 6 years and so on. And so I do think that people tend to overly focus on this. Currently.
If I can back up just a little bit, I asked. I think the number one question is, hey, can these guys continue to find accretive acquisitions, right? Because if they can continue to find accretive acquisitions where they're paying 4 or 5x and kind of getting that 20% return on capital, and especially if they can scale that up, this guy is kind of limited here. I think that's the number one question. Your write-up had I don't know if, I'm sure you remember it, but if you don't, I'll refresh your memory. It had the Halma example as a answer to that question. And I just thought it was such a nice example. I just wanted to pause here and let you present that as kind of a rebuttal to that question.
Yeah, so Halma is a serial acquirer in the UK that operates in scientific instruments as well as a couple other industries. And they, of course, had the exact same issue where they were buying these types of businesses 15, 20 years ago, and they got to a level of scale where these small acquisitions were less meaningful. And what I did is I looked at their cash on cash returns over 5-year periods. So I looked at, okay, let's sum up the total cash spent on acquisitions, CapEx, and working capital. And then let's compare that to what the growth in operating cash flow was and use that as a proxy for, okay, this is how much they've invested over 5 years. What was the resulting return on that investment? And if you do that analysis, you'll see that when Halma had revenues under 500 million, they had very similar returns to Judges. So 20% plus. And over time, that reduced as the size of Halma increased. And, today it's kind of more like just over 10%. And the point of that was to say, well, that moment when Halma really saw diminishing returns on acquisitions was when they reached 500 million in revenues. Judges today is at 130 million in revenues, so a long way below that. I would also say, if we think of other serial acquirers, I think first time I was on this podcast, I was talking about TerraVest, and TerraVest today will generate about revenues of 1.4 billion Canadian, and they're still finding great deals. They're doing $20 million deals that they're now not even disclosing the financials for because it's small relative to TerraVest. So we're talking about whether Judges can do 5 million or 10 million pound deals. So I think these are still very small companies with a lot of runway.
So I think you're 100% correct, though. TerraVest, it's more commoditized businesses. So I just don't know. And kind of businesses, I hate to use ESG because it's not fully ESG, but businesses with like a little bit of an ESG overhang, whereas this is lab tools. So I do understand, hey, there are lab tool businesses that have billions of dollars market, but I do wonder if as you step up from 10 to, let's just use 100 million, right? You're not buying from mom and pops anymore. And there are Thermo Fisher wants to snap up every single 100 million EBIT business, 50 million.
Yeah.
Now, I used 100 million EBIT, not 100 million valuation, but still there's, mid-tier life science tools. Like I do wonder if this has a little bit more of a cap versus a TerraVest where it's like, hey, nobody cares about 100 million oil and gas, tank, gas tank, whatever it is. I just wonder if that's the case,
Yes, I think you're right. I mean, there will be a point when we get those diminishing returns. I just think it's still quite far off. So for context, Judges' free cash flow this year will be something like 20 million pounds. So that will grow over the next 3 years. They can take on some debt, but their acquisition spend over the next 3 years is probably going to be something like 80 million, unless they find some, really attractive deals. So, 80 million, depending on how many deals you think they can do, those are still fairly small deals. So I don't think we're at the point, even in, over the next 3 years, where we're really hitting those diminishing returns.
Perfect. Let's talk management. And you already addressed it a little bit, but this is a CEO in his 70, he's 76. This is not Constellation with 10 years ago with a CEO in his early 50s where you say, hey, I've got 20 more years of kind of growth if I'm almost unlucky. This is not
Yeah.
Berkshire in the
Yeah.
80s where you say, I've got 40 years of warrant, but 76, he's either going to retire or pass away in the next decade, 15 years, a kind of on the upper limit. And, even at 76, you start worrying about slowing down. What do you worry? How do you think about just kind of the succession issue here? And you did mention they upgraded the team, but still, you lose that founder, the driving force behind 50 deals here. You worry.
Yeah. Yeah. I mean, I consider this the biggest risk. He's 76. Just in terms of his actual role today, he has been reducing his role for the best part of a decade, to be honest. So he's very focused on the acquisition side. He doesn't really get involved post-acquisition. So the COO who really manages that. So his focus is on acquisitions. And I mean, first of all, he hasn't said he's going to retire, and I don't think he's the type of person who is likely to retire anytime soon. I think what is much more likely is that he moves up to chairman. The chairman who's quite old as well, and I would expect at some point maybe the chairman retires and David Cicurel, the CEO, moves up to chairman, and I think that's okay because the most important thing that he brings is just that discipline on acquisition multiple, and going 2 years, not overpaying. In terms of technical expertise, they have that already with the team they've brought in. In terms of sourcing, I think that can also has been replicated, and they're adding people on that as well. So I think those are all replicable. I don't think the day he goes, Judges is suddenly going to be very hands-on with companies. And one of the things I asked in my due diligence as well is, how much of this reputation of being hands-off and being an attractive acquirer is with David Cicurel versus with Judges, the company, and the response was generally it's more with the company. So I do think that the thing that they will miss is just that discipline. As long as he's involved with the company as a chairman, I think that's fine. He can still say no to deals. And so I don't think that certainly over the next 3, I don't think next 5 years he'll be exiting completely. He's still got the majority of his net worth invested in the stock.
Speaking of majority of his net worth invested in the stock, and I think you had in the write-up, his stock ownership is 100x what he gets paid, and he had a nice quote on Q4 in the Q4 earnings call where he was like, "I'm obsessed with shareholder value. It's all we want to do to create." Would this be an attractive, if 4 years from now he's 80, he says, "All right, it's time for me to really have." Would it make more sense for him to sell this to a private equity firm, or would you just kind of like be lose? I could imagine both ways, where you sell to a private equity firm and they like the platform and they want to keep the platform as is, or you sell to a private equity firm and they say, "Hey, we own these things. Let's roll them all together and get that one-time synergy hit." Or I can imagine you say, "Hey, no chance they sell to a private equity firm, because once you do that, you lose the culture and you're going to risk that." And so I can see every which way. What do you think would make most sense?
I think it's unlikely he would sell the company. I think if they sold to private equity, even if the private equity firm was hands off, I think that image, the reputation they have of being not private equity, I think that would obviously be difficult to maintain. I also think he's a little bit like some of the founders he buys from. I think this company's his baby, and he doesn't really want to see it changed in a material way. So I think what is much more likely is that he is building the team, and I think his success is already with the company. I think it's a guy called Tim Prestige. I think it's much more likely he keeps it on like that.
Perfect. Let's Q2. Towards the end of July, they come out with a Q2 or H1 update. Now, this is a British company, so the H1 update, they're actually going to report full earnings in September, I think. So you don't get the DAG, you don't get the call, you don't really get a lot of commentary. But they pulled down their guide, right? And they said, "Hey, the big issue we're having is U.S. government higher education." So I just want to talk about people are going to look at the chart and say, "Hey, why was this down 3 weeks ago or something?" So I just want to talk about the government guide, what's going on, if that can, obviously nobody loves to get hit in the face, but is this one time? Is it going to get made up? How do you think about that?
Yeah, so about 3 weeks ago, as you say, they had their trading update and they cut their guidance for EPS by between 10 and 20%, or 22%, I think. So they gave a range. Roughly speaking, it's about £3 per share. So the stock is at £60 right now. So the US is about a third of the company's sales. Within that, We don't know the exact amount that ultimately ends up with US colleges, but it's probably something like half of that. And essentially, college spending on new equipment has come to a complete halt since March. Now, I have to admit, I was a bit surprised by the extent of the reduction because in March, when they had an earlier trading update,
Yes.
they had their full year guidance, and this management team is historically quite conservative and very high integrity. So they were surprised, and I was surprised. So I think what happened is, in March. President Trump made various announcements about cutting scientific funding in the US. So, depending on the institute you look at, it's somewhere between a 20 and 50% cut. So, the National Institute of Health, for example, which is one of the biggest ones, 40% cut. Um, so that really happened in March, April, May, and on top of that, there's a second issue, which is there's obviously uh, don't know what the right word would be, but there's a confrontation going on between the US government and certain colleges. Um, and that's not just specific towards scientific instruments, it's really around other topics, but pulling government funding across the board is one of the tools that the administration is using. And so that has impacted them quite heavily.
And these are the largest research institutions, right? So it's not
Yes.
just it's like probably the biggest buyers of the tools who are having the threads, having everything
Yes.
frozen. Yeah. Now the question is kind of like, look, you've already seen a few colleges settle with the administration. But the NIH funding cuts are happening. You have
Mhm.
seen the universities, but the question kind of is, hey, now it's a small piece of the sales, right? About a third of the sales, and then half of the. But is this a one-time cut and then it bounces
Yeah.
back next year, or is this a for at least the next 3.5 years until we maybe get a new administration? All these levels are going to be low, so you're kind of on a much lower baseline going forward, or all the universities are scared of their own shadow for another 3.5 years, so they refuse. They're kind of looking over, and as you said, a lot of these instruments are thousands, tens of thousands of dollars. They're kind of looking over every line item and saying,
Yeah.
"Hey, maybe we don't
Yeah.
need the microscope." How do you just kind of think about that?
Yeah, I think it's a very good question. So I think what is hurting them right now is not just the actual cuts, because actually a lot of the cuts are proposed cuts, um, as well as some grants that have already been made that have been frozen. There's a good website called Grant Witness, which you can kind of track this stuff. What's hurting them as well is just the uncertainty. You can imagine if you're a college in the US. Regardless of whether you're actually Harvard or Columbia, if you're just a college and you're seeing all this happen, you don't know whether your grant funding will actually come through. Will the administration come for you next? And so there's just a lot of
Yes.
uncertainty. And that uncertainty is really actually the bigger killer than the actual reduction. And so what's basically happened right now is there's been an almost complete halt of college spending on new equipment. And so to the question of, is this front loaded? Is this kind of 3 years? Because it's basically gone to close to zero since March. This should be front loaded. I mean, it can't go lower than zero. So I think that ultimately we are seeing some resolutions. I think Columbia settled and they've had their grant funding restored. Brown the same. Um, so any type of resolution, whether it's regardless of the size, any sort of resolution will reduce uncertainty. And I think you'll see some level of improvement from here. Now, I think that, I would assume that there is going to be some significant reduction in scientific spending regardless of the resolution. Okay. And there's House and Senate committees trying to fight that, but we just assume for now, they end up at a 20% cut or 30% cut. But right now, the spending is reflecting like 100% cut because they're just stopping all spending. And so I think you're going to obviously see that be a headwind in the second half of this year. It's in the guidance. You might see a little bit first half of next year, just because in Q1 you won't be lapping this uncertainty yet. But basically, from then onwards, you should see some recovery. If spending goes from minus 100 to minus 50 or minus 30, that's actually quite a significant recovery. So instead of seeing the company grow at, let's say, 7 to 9% like they have done historically, you might see them grow at double-digit rates from a lower level.
The other interesting thing is cleanish balance sheet here. these guys, yes, it sucks in the short term, but you have to wonder, hey, is there a 5 million revenue business out there that's run by a mom and pop where all their orders just got canceled, and they're calling up and saying, hey, we've got an inventory bill coming due.
Yeah.
Like we had ordered for this. So you have to wonder on the other side, is this a moment for these guys to go buy and make some really accretive deals in a sector that's probably not super loved right now?
Yeah.
Let me talk valuation real quick. You mentioned at the front 21, I'm just going to call it mid 20s free cash flow multiple here, right? Now, this is a business that historically, as you said, has grown mid to high single digits plus accretive acquisitions. So 20s is probably a fairish multiple for a normal business. And then you get above normal business, like there's extremely limited CapEx. You get great tax, all this sort of stuff that you leverage on the thing. So a business like that could easily sustain a 40, 45 times multiple, I would say, if you believe everything that Chris is presenting. But I just want to push back a little bit. I mean, mid-20s multiple and saying, hey, 3 years out, I'm going to slap a mid-20s multiple on this, assume the continued growth, assume the continued accretive to get like an IRR that's in the 20s. Those are aggressive assumptions. So like, where do you get the confidence that? Because I would push back as, hey, if acquisitions are a little slower and growth comes down, and all of a sudden you're looking at a 15 times free cash flow multiple, you get like the reverse Davis double play, right? Multiple comes down, growth comes down, boom, everything's like you get a pretty negative IRR pretty quickly.
Yeah, I mean, it's something I've thought about in terms of, like you say, if you were just to look at the organic growth of the business, is take away the acquisitions for a second. 5 to 7%. Or 7 to 9% organic growth trading at 20, 25 times seems fairly priced. But I think, this is a serial acquirer. And so I would obviously very much look at what is the total amount of growth they can achieve. And if they can invest 100% of earnings at 20% returns, that's 20% earnings growth. So, how long a runway do they have to keep doing that? So if they can grow, what should a business that can grow 20% or even just kind of teens for a long period of time trade at? I think when you look at it that way, then, 21 times valuation is very fair. And so in my valuation, I don't assume that the multiple goes up. Or I don't assume any significant multiple expansion. You can sort of take your own view on that. If you think the multiple stays the same, then you earn whatever the earnings growth is. And if you think it comes down, then you have to take some of that off. I just think that if you look at other comps, there are a lot of serial acquirers like this that trade well into the mid 20s, sometimes even 30 times free cash flow. And so kind of regardless of my argument, organic or inorganic, the reality is I think that the market does pay these types of multiples or higher. And so I think that if they can, they've got a lot of short-term headwinds, which they're going through right now. And at some point, I think they can get back to normal. And I think the market has shown it's willing to pay these types of multiples for a business like this.
The only piece of it is a lot of the loose comps that trade for mid 20s to low 30s multiples. I think their organic growth on the businesses that they buy is actually lower than what Judges has. So if it works, it should trade for, now maybe there's a little bit less acquisitive growth, but if it works, it should probably trade for a higher multiple than those businesses would be my supposition.
I mean, these businesses are higher quality businesses. Yes. There's no doubt. I mean, they're significantly higher quality. Depending on which serial acquirer you look at, but certainly compared to the more industrial ones, these are much higher quality businesses.
One last question, and then I'll turn it over to you for kind of final thoughts or anything if I missed anything. But I can't claim credit for it. This came from someone on Twitter, but they tweeted out, "Hey, in January, the management team got a option grant that was based on achieving 5% per share EPS over, I believe it's the next 3 years. And their prior option grant, if you looked at the bottom of that press release, was 10% CAGR over the next 3 years. Now, the company, to their credit, said, hey, there was a UK tax increase from 19 to 25%, so we don't think we should give 10% again. But people are saying, hey, this is supposed to be a compounder business. We've talked about all the reasons, right? 5% revenue growth, great leverage, acquisitive. Is giving them EPS targets at 5% for 3 years, it kind of seems either out of line with everything we've been saying or too generous?
Well, it's a very astute observation, and it's one that I noticed as well, going through the compensation package. Frankly speaking, I think it should be higher than 5%. So, I would very much support a higher number than 5%. I think if you look back through their history, yes, it was at 10% previously, but actually before that, it was at 5% as well. So I suspect in their minds, they're just going back to what it always was. But, yeah, frankly, I agree. It should be at a higher number. I would also say that I suspect part of the reason they want to be generous in giving management options is because obviously the founder has a lot of shares. The COO owns shares about 20 times his base salary, which he's accrued through these option packages over the years. But they've got these newer members of management, and I think they want to get them in a position where the primary determinant of their comp is the share price performance. And so I think in some ways, if there was no EPS target and they were just getting options, maybe we wouldn't have a complaint. But I think that's partly behind why they're being generous in that package there.
That's great. The actual last thing, I know I said last thing, but one more.
No.
I do think it's worth quickly discussing. The company pays out a dividend, and I think
Mhm.
you and I are domestic based. Despite Chris's accent, he's domestic based. Most of my listeners, I'm sure, are domestic based. And just when you think about serial compounders, until serial acquisitive compounders, until they're in the very, very late stages of their cycle, you tend not to see them pay a dividend. And I mentioned the domestic because I think in London, the culture is a little bit different on dividend payments. But they've clearly thought about it. They've gotten questioned. They addressed it in the Q4 call. I just want to talk to you quickly. The dividend policy here, do you think it makes sense? Are you willing to just kind of give it a pass? How do you think about all that?
Yeah, I mean, the punchline is I think they should not be paying a dividend. I think if you can generate 20% returns on capital with investments, paying out at your cost of capital minus income tax is not the best use of cash. So, ultimately, I would prefer that they just reinvested everything. I think that some of the points you made, there is, unfortunately or fortunately, a very different culture in the UK around a lot of income funds and a lot of investors. Their shareholders see that as important. And I think for the founder as well, he has quite a low base salary. And so his dividend payment is actually where most of his income comes from. And I think for some of the other members of management is pretty meaningful as well. And so I think that's the idea behind it. But yes, I would prefer they just invested in acquisitions.
Do you know what the biggest red flag I saw in Judges was the whole time I was
Well,
researching it?
well,
At the end of the Q4 call, when they were asked about the dividend, he said, "I've been to Berkshire several times. I've read Warren
yes,
Buffett and Charlie Munger,
yeah,
and I know they don't pay a dividend." And my history of serial compounders, when they reference the goats, my history is
yes,
that it's heading
yes.
poorly.
That is, it's definitely, I've seen a number of companies which, whenever whenever your selling point is something someone else has done, that's usually not a great selling point. But in this case, they obviously have the 20-year record.
My favorite was I can't remember if it was a public deal or if it was one that I got shown kind of privately that got pulled. I can't remember, but it was a deal to buy a crypto, right? It was going to basically turn it into a digital asset treasury company. And the headline quote was like a Charlie Munger quote. And I was like, Charlie Munger was the most anti-crypto person in the entire world. He would be rolling over in his grave if he knew that you were using this to launch a digital asset treasury company. So look, Chris, credit to mainly you because most of my research was reading your report, reading your follow-ups and all that sort of stuff. But I think we've done a really nice job explaining Judges Scientific, talking through all the bull cases, bear cases, everything. But I just want to pause here. Is there anything else that you think we should have hit or that listeners should be thinking about that we kind of maybe glossed over?
Probably just the only thing we touched on it a bit, but probably it's worth fleshing out what actually happens to these companies after the acquisition, because
Sure.
they are, Judges is very, very hands off, but to the point where they don't integrate IT systems. They're really very hands-off. In fact, some of the founders told me that basically they wouldn't have really noticed, they haven't noticed a difference in terms of their actual business, pre and post acquisition. So it's very hands-off, but there are a few things that they do. So one is just reporting. A lot of these are very small businesses. They don't have great reporting and KPIs and so on. And so Judges does demand that every month, and that tends to have an impact on the business once they're more focused on these financial metrics. The second thing is just around succession. So a lot of these founders, they're either retiring immediately or usually after a couple of years. Judges are very, very good at managing that transition, which is actually quite important, because if you think of small businesses, quite often when a small business loses its founder, that's a lot of the value leaving. And so the fact these businesses have continued to grow at 9% organically, it looks like nothing's changed. But actually, if you look at the counterfactual, if it had not been acquired, it probably doesn't grow anywhere near that. So that's the second thing. And just the last one is in terms of guidance, so that they don't push anything onto these businesses, but they do try and pull them effectively on a couple areas. So one would be pricing. A lot of these companies have very strong pricing power and haven't used it. And the other thing is just on R&D, making sure that's focused on projects of a commercial outcome, not a science project. So those are probably the two things I would highlight that they encourage as well.
Most of my time this year has been spent on net cash biotechs after they bust out on phase 3 and they take a discount. And I will tell you, I would love to have control of these and make sure that all of the R&D spend at these companies was going towards commercial prospects and not towards, hey, we've got cash and we've got a thing, we've got to do R&D. It's like, well, look, if it's a way to shorten the average person's with a common goal to take it from 7 days to 6 days, 23 hours and 58 minutes, like that's maybe not something we should be investing money in, because there's not a lot of commercial potential there. Because guys, like $100 million phase 3 doesn't really make sense for that. That's just my rant, and I don't even know which.
It is a business. Ultimately, it's a business, and yes, Judges are good because they have great technical expertise, but they are very business focused, very returns focused, and so they're able to kind of get the best of those.
It's the wonderful thing about having, hopefully a shareholder focused control shareholder who's overseeing these businesses. Cool. Well, okay, if that's it, Chris. I mean, again, love having you on the podcast. The great thing about Hidden Gems, it's only a couple of emails a month, and they're all very well focused, deeply thought out. So I love reading it. I'm sorry you can't make dinner next week, but have fun in Rhode Island, and looking forward to catching up soon.
Great. Thank you for having me. And thanks to everyone for listening.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.